FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ashish Kejriwal from Nuvama Wealth. Thank you, and over to you, sir.
Thank you, Amshad. Good afternoon, everyone. On behalf of Nuvama Wealth Management, we welcome you all for Steel Authority of India's first quarter call. We are pleased to host Dr. Ashok Panda, Director of Finance, along with his team. Now, I would request the management for his opening remark, and thereafter we can open the call for Q&A. Thank you, and over to you, sir.
Thank you very much, Mr. Ashish. Very good afternoon, everyone present to this phone call. Let me welcome all our investors and analysts who are joining this result con call for the financial results of SAIL for the period Q1 FY26. I am sure most all of you would have gone through the financial results available on the website of the company and stock exchange. Results were out on 25th. However, I would briefly apprise you on the same before we move to the question and answer section, where we would be happy to receive questions from your side and try to answer those questions. Let us look at the economic scenario. Let me first apprise you on the economic scenario in which we've been operating. The global economy has been battling the inflationary forces for quite some time now. The countermeasures by the economies across the globe led to the decline in GDP growth rates in the countries. Global GDP growth rate is projected at around 2.4% in 2025, down from nearly 2.9% in 2024, driven lower by escalating trade tensions, rising protectionism, and policy uncertainty. IMF forecast it at approximately 3.3%, and OECD advanced economies like US and Eurozone to grow just at 1.3 to 1.5%. This slower pace is fueled by a tariff, particularly sweeping US trade measures and fragmented supply chains. Global inflation is cooling right now. Headline inflation is expected to fall to around 4.1 to 4.2% in 2025, down from pandemic era peaks. Nonetheless, central banks remain cautious about it. The ECB recently held its benchmark rate at 2%, giving lingering trade war risks, while US Federal Reserve, despite maintaining a high interest rate, hints at rate cuts later in the year if inflation continues to abate. Amid global headwinds, India continues to outperform. India's fundamentals remain stronger. Over 80% of Indian CEOs are optimistic about the growth prospects, buoyed by demographic advantages, expanding middle class, and a shift towards service-led development. In fiscal year 2024-25, GDP growth reached around 6.4%, driven by robust private consumption of growth at 7.3% and healthy activity across agriculture, industry, and services. Central agencies like OECD and UN project India's economy will expand by roughly 6.3 to 6.7% through 2026. Inflation levels are remarkably low. Retail inflation in June stood at just 2.1%, well below the RBI's full-year target of 3.7%. With easing price pressures, the RBI is signaling room for interest rate cuts to boost liquidity and investment in the country. The Indian government's multi-pronged strategy aims to counter global disruptions with domestic strength. CapEx is the growth engine for our country, and we're expecting CapEx to increase further. It will result in sustaining long-term growth, promoting infrastructure-led investment and job creation in the country. Foreign trade push, the recently signaled India-UK FTA in July 24 July 2025 is expected to unlock opportunities for startup companies, manufacturing and services exports without compromising India's strategic interests. On the front of global and domestic vulnerabilities, we still remain with respect to rising protectionism and volatile capital flows due to trade disputes, particularly US tariffs on China and Europe. agricultural and rural inflation spikes post-monsoon, climate shocks impacting global food supplies and commodity prices. India should build capabilities in services and high-value sectors going forward. When we talk about the world steel scenario, coming to the steel scenario, the same has been much in line with the economic situation. As of mid-2025, the global steel market is growing slowly, with total demand expected to rise by just 1.7% globally, according to WSA. Advanced economies, particularly Europe, Japan and US, are experiencing stagnant or declining demand, mainly due to slower construction activity and higher interest rates. On the contrary, developing economies led by India, Southeast Asia and parts of Africa are driving demand through infrastructure, urbanization and industrialization. China, which accounts for more than 50% of the global steel production, is facing a historic slowdown in domestic demand, largely due to prolonged real estate crisis, tight credit conditions and weak exports. In response, Chinese producers are offloading excess steel in international markets at lower prices, leading to global oversupply and price suppression. This has triggered trade tensions and protective measures across several countries, including India, UE countries and US. Now let us look at the Indian steel industry. Coming to this industry, domestic steel demand is growing at a rapid pace, over 8% annually. This demand is driven by infrastructure projects, affordable housing, railways, ports, highways, growth in automotive, defense and renewable energy sectors. India's per capita steel consumption has doubled in the last decade, reaching more than 120 kg right now, though still below the global average, but it is indicating immense headroom for growth in the future years. However, challenges remain in the form of rising imports, global oversupply and input dependence. Input dependence means it is basically coking coal. Its variability in the price is determining the cost of production out here. Rising imports means steel imports surged over 24% in 2025, especially from China, Vietnam and Japan, creating price pressure on domestic producers. However, imports in this Q1 of this year is under control. The prices of steel have also been operating in a narrow band, but with the prices stabilizing in the past 1 or 2 weeks right now. There are hopes for improvement in the next quarters, which has traditionally remained the strongest for steel producers. Now let us discuss about the company performance for the quarter Q1. Coming to the performance of SAIL during Q1 FY25-26, the same has been as follows. Saleable steel production during the quarter stood at 4.7 million tons as against 4.2 million tons last year Q1 with a growth of 12%. Sales volume stood at 4.55 million tons as against 4 million tons in last year Q1 with a growth of 15%. In fact, this is the best ever first quarter performance in sales in any financial year for SAIL. On the financial front, due to impact of lower prices, turnover could register a lower growth of 8%. Added by improvement in efficiency parameters, the profit before tax registered a growth of more than 2.7 times to stand at 890 crores this quarter, vis-a-vis 326 crores last year Q1 before exceptional items, and after exceptional item it was I think only 14 crores last year Q1. The company continues its drive towards reduction in borrowings as on 30th June 2025, which stood at 28,741 crores as against 29,811 crores as on 31st March 2025. So we have reduced our borrowings by around 1,100 crores in Q1 this year. So on the front of sustenance and operational efficiencies, we have improved the fuel rate, coal to hot metal ratio, increased CDI and reduced coke rates, reduced specific energy consumption this quarter as compared to the previous quarter, which has given us advantage in the cost front as well as greening the steel. Our CO2 emission levels have also improved in this quarter as compared to the previous quarter, as compared to Q1 of last year. However, we are still having more targets to improve it further. We are focusing on zero liquid discharges eco-restoration of areas and regions, and we are focusing also on CSR activities for giving benefit to the stakeholders in the society. So this is not about the overall scenario. With these words, I hand it back to Mr. Kejriwal for opening the Q&A session. Thank you. Mr. Ashish?
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in this conference, please limit your questions to 2 per participant. We will wait for a moment while the question queue assembles. The first question is from the line of Amit Lahoti from Emkay Global. Please go ahead.
Thanks for the opportunity. My question is on cost. So, how much was our blended cost of coking coal in Q1?
Yeah, that is the question. It is 16,918 rupees per ton.
Okay, so it is flat versus the previous quarter.
Previous quarter was 17,653 on an average. So there's a bit of improvement here, around 600-700 rupees per ton.
Okay, so we are seeing better coking coal prices as well as the coke rate. So one thing which I wasn't able to reconcile was the delta in EBITDA per ton, and that is partially due to higher cost. So if you can help reconcile that, which cost items have actually moved up?
Yeah, regarding you're talking about EBITDA per TSS, which is 6,400 now as compared to 6,000 rupees in Q1 last year. So when we look at the imported coal price, average coal blend cost 16,918. So Q1 previous year was, just one sec, 20,000. So it is a little less than that. There is an improvement in the production volume in this Q1 as compared to the previous Q1. Yeah. So in the EBITDA numbers, when we talk about EBITDA numbers, actually we've got advantage in the imported coal, and because the royalty is more in the iron ore, so there is a disadvantage in the NSR front. There is a disadvantage, but EBITDA is also down. EBITDA per ton of cellulose is down primarily because of the stock valuation rates. Because as you understand, because of the reduction in the imported coal rates, the cost of production has come down. And as a result of that, the stock valuation rate of the items, steel items and iron items, they have come down drastically. So it has impacted the P&L account in terms of accounting. That's the reason why the EBITDA per ton of saleable steel appears to be little less as compared to last year Q1.
Okay, and where do we see the guidance for Q2 on coking coal?
Because so far as Q2 guidance is concerned, coking coal prices are almost flat as it was in Q1. We are hoping that it will remain at the same level, a little bit of variation here and there. Won't be on the downside, could be little up or maybe at the same level. That's about the coking coal. Now talking about the stock valuation impact, it is a one-time impact which has come in Q1 because of the reduction in the cost of production and then transition from last year to this year. So that impact is unlikely in Q2. It will not be there in the Q2. So Q2 will have advantage with respect to stock valuation rates, and the coal prices will remain flat. So that will ease out cost of production.
Okay, thank you and all the best.
Thank you.
Thank you. The next question is from the line of Amit Dixit from Goldman Sachs. Please go ahead.
Yeah. Hi. Good afternoon, everyone. Thanks for the opportunity. Couple of questions from my side. The first one is on the capex. So what was the capex in this quarter? How much capex do we expect this year? And if you can also highlight the status of the capex project that we have planned, plant-wise.
Yeah, capex. First of all, let me tell you, capex last year was close to 6,000 crores, and this year we have kept a target of 7,500 crores for the year, which is a higher target, and we are confident that we'll be able to achieve that. And in quarter one, we have already crossed the target which we have given. I'll just give you the number a bit later. The number is quarter one target was how much? Quarter one we have achieved 1,642 crores, which is more than the target we had set for the quarter one. And then for the entire year, the target is, as I have told, 7,500 crores, and we have got the plans to achieve it. So far as the facilities are concerned, as you said, actually, we've got the facilities which are in the pipeline, the facilities which are under execution. From there, we are getting the capex, and SAIL is doing expansion, and to start with in ISCO steel plant. So the majority of the lot of expenditure of capex in ISCO will come from next year. So that means from next year onwards, the capex figure will be still higher than 7,500 crores, which is there this year. A bit of that ISCO capex on account of expansion may surface this year, but most of the capex will be from the ongoing projects which are happening in the various plants. Yes,
Okay,
please.
sir. The second question is on the rail price revision. So saw some, advantage that we had to the tune of 173 odd crores. Now this pertains to FY24 as highlighted in notes to accounts. So just wanted to understand the current rail price and what was the rail price booked in FY24. And how much of this advantage can we get further down the year?
Yeah, let me tell you the figure. The figure which was finalized by Joint Pricing Committee was for 23-24, and on that basis, because we had taken the income at 78,000 rupees, so it was a little more than that, 79,000 something. So it got around 173 crores in the accounts. That is for 23-24. Now 24-25 incomes were at 78,000 rupees, which was continuing. Now from 25-26 onwards, the provisional price has been at 74,000 rupees per ton because of the softening of imported coal prices. So the provisional prices has been kept less. So that's the reason. That's the reason why accounting is already done in this manner, and going forward, we'll have no issues on this.
Can we expect some more benefit from this, or everything for FY24 has already been taken into account?
More benefit in this sense, this already...
Due to rail price revision.
Yeah, rail price revision benefit will not come in this year further because this is already actualized. It's already actualized, and that is why no more areas are expected in this year.
Got it, sir. Thank you so much, and all the best.
Thank you. The next question is from the line of Ashish from MLP. Please go ahead.
Hello. Hi. Am I audible?
Yes, sir.
Yeah. Hi, sir. Sir, how much is the stock valuation impact this quarter?
Yeah, stock valuation impact this quarter is around 1,050 crores.
So this is 1,050 crore is a one-off which will not repeat next quarter onwards. Is that correct to say?
It will not repeat next quarter. This is quarter one versus quarter one.
Okay. And this was not there in Q4?
This was not during last Q4. Last Q4, every quarter
Yes.
there is some amount of stock valuation impact. Either it is plus or minus, something like that. But majorly it was not there in Q4. So when we compare this Q1 versus Q4, impact is around 950 crores.
Okay. And also, what would be the impact because of higher royalty on iron ore this quarter?
This quarter is basically because of the IBM price.
What is the Q4? Yeah.
Versus Q4, it could be somewhere around, we had, say around 250 or 260 crores. Just 173 crores to be specific.
Okay. And did you get any revenue? Sorry.
Yes, please.
Did we get any revenue for sale of NMDC steel? For marketing NMDC steel?
Yeah.
Quarter? Last quarter we highlighted we got some revenue.
Yeah. 0.373 million tons we have sold actually, and
1,800 crore revenue.
so we have got a revenue of around, in this quarter, around 1,800 crores odd. That revenue we have sold.
Okay. So adjusted for that, what would be the realization increase this quarter versus Q4?
In terms of what? Rupees per ton?
Rupees per ton, yeah. NSR increase rupees per ton for Q1 versus Q4.
Just one sec. So Q1 versus Q4. Q1 is around, you can say 1,600 rupees per ton. Increase in
1,600.
Yeah.
Okay. And how should we look at the NSRs for average of Q2 versus Q1?
See, everybody knows about it actually, because in the rainy season, which is there in Q2, the prices remain little suppressed. So steel prices are down in July. But as I have already given in my opening remarks, that in last 1 or 2 weeks, it has started improving. There are signs of improvement in the prices in the flat as well as in the long products. So hopefully next month and next to next month, August and September, the slide which has taken place in July would be offset. But Q2 price should be down as compared to Q1. That is what it looks like at this moment.
Understood. Fair enough. Thank you, sir.
Thank you very much.
Thank you. The next question is from the line of Prateek Singh from DAM Capital Advisors. Please go ahead.
Hi, sir. Thanks for taking the opportunity. Just following on Ashish's question earlier, if you can give us actual numbers for NSR, both flat and longs for Q1 as well as Q4 in rupees per ton.
Q1 and Q4. So Q1 long is 54,500 and Q4 long is 53,300. In case of flat, Q1 is 50,400 and Q4 is 47,300.
So, sir, if we saw a decent increase in NSRs, I was a bit confused when I look at the slides. So, the slide where you show an EBITDA bridge from Q4 to Q1, two things caught my eye. One was that the sale price / NSR, we are putting a negative number in the sense that it's impacting the EBITDA negatively when moving from Q4 to Q1. That is one. And second is the raw material usage is also hitting us negatively. What is the raw material usage? I would assume that given that we produce less, so usage also would be lower.
Yeah. No, it is not like that actually. I can explain you. When we compare, you are asking a question about Q1 versus Q4. So when we compare Q1 versus last year Q1, everything appears to be very positive. But when we compare Q1 versus Q4, then even raw material usage front, there is a negative, because the techno-economic parameters in Q1 are adverse as compared to Q4, because Q4 happens to be the best producing month, and that is why best techno-economic parameters as well as production volume. In Q1, what happens in all the organizations, they go for capital repairs, shutdowns and all that. So productions are not that consistent as compared to Q4, and that is the reason why when we regulate and throttle the production, then the techno-economic parameters also get impacted. So that is why the raw material usage is adverse in this Q1 compared to Q4. However, these are better than Q1 of last year. And so the production volume in this Q1 is less than that of Q4 of last year. But Q1 as compared to Q1, there is an improvement even in the production volumes. So that is why...
NSR?
Pardon?
On the NSR, sir, why are we showing an adverse impact of NSR despite an improvement?
No, if you look at that actually, that can be split into two categories, which we'll do from the next time. One is NSR impact and the other one is stock valuation impact. So when we look at the total net impact is 258 minus. Out of that, around 950 crores minus is because of the stock valuation, and you can say around 600 to 700 crores plus is because of the sales price increase. So on the sales NSR front, there is a positive around 650 to 700 crores. However, there is negative on account of stock valuation rate impact of around 950 crores. So on the whole, it is minus 258 crores.
Understood, sir. And sir, can you just tell us what are the spot NSRs right now in longs and flat?
What are the, pardon?
What are the current NSRs that we are seeing right now, maybe as of
Okay, current NSR means July expected NSR is somewhere around, long is around 51,500 rupees and flat is around 48,600 rupees.
Understood, sir. And so any guidance as to what kind of full year volumes in terms of sales you would be doing?
Where, in quarter two?
No, sir, full year for 26.
Yeah, for the full year, we are expecting somewhere around 18.5 million tons.
Okay. And just a last, just a suggestion, this is something which I have seen over the past few quarters. In the production performance slide, sir, it would be best that we mention whether it's for the quarter or for the cumulative till that quarter, because this time it's saying FY25, so I assume it's 1Q because it's easy. But usually in 2Q, 3Q also, it says FY25, then we get confused whether it is for the first 3 quarters or only for that quarter. Just a suggestion to make it more clearer in the production performance slide, sir. Thank you.
Yes, we've noted your suggestion. We'll do the needful.
Yeah.
Thanks a lot.
Thank you. The next question is from the line of Kamlesh Bagmar from Lotus Asset Managers. Please go ahead.
Yeah, thanks for the opportunity, sir. Sir, I just wanted to understand more about this stock valuation. I think it is more of a finished goods valuation. So, is it more that we have valued the inventory at the current prices, or what we have done with the stock valuation? Because for the first time we are getting the adjustment from your side that in sale we are seeing the stock valuation thing.
No, let me answer this question. Actually, stock valuation is there everywhere, every time, by every company. It's done by every company. It's a part of the P&L account. And now, in this year, because there is a transition from last year to this year, and as all of us know, coal prices are down. So when the coal prices are down in quarter one as compared to average of last year by around 6,000 rupees or whatever it is, based on that the cost of production is also quite less. And since cost of production is less and our stock valuation is taking place with respect to cost of production, not NSR, that is why there is a hit on the stock valuation rate in stock acquisition and depreciation. And this impact is around 1,050 crores quarter one versus quarter one, and around 950 crores quarter one versus quarter four. So this is just one time true up of the stock valuation rate in the stock acquisition depreciation.
It is related to coking coal only.
It is mostly related to the coking coal. But the cost is not only decided by coking coal, it's based on the efficiency and other things, but impact of other items are pretty less as compared to the imported coal.
Okay. And secondly, on the capex side, sir, have we got the approval from the board on the capex side? Because we were telling that we were guiding that there would be new capacity announcements and all that out, and we would be placing the orders for that capacity. So any update on that part?
Yeah, we have got it approved. 7,500 crores for this year is approved by the board, and that is our target. And as you have mentioned about the new capacities, we have got the expansion plans in pipeline, and the tendering activities are going on in ISCO steel plant, wherein we are planning to have 4.5 million tons of expansion over there. And as I have already explained, that the expenditure in that will generally start from the next year, from 26-27, because the orders will be placed and then the other activities will start from next year, and that is how the expenditures will start coming from the next year regarding that expansion. And back to back, we are planning expansion in other plants as well, in other facilities. So those things will also follow going forward.
Okay, thanks a lot.
Thank you. The next question is from the line of Sumangal from Kotak Securities. Please go ahead.
Yes, sir. Thank you, sir. A couple of questions. First is, sir, given that the ISCO expansion will kind of pick up pace next year, the 7,500 crores could go to what number ballpark for FY27 capex?
So actually, as we have discussed, after tendering and auto placement, the execution activities start and the expenditure will start from the next year. We are expecting a good jump as compared to 7,500 crores next year onwards. So the actual numbers will come only when the packages are crystallized. But then I can expect that a good jump will be there in the next year as compared to this year. 9 to 10,000.
Okay, and this ISCO will be roughly 4 million tons new capacity and some debottlenecking, right? 500,000 ton debottlenecking.
Yeah.
Yeah, so total we are looking at some, for ISCO only, what would be the total capex? Somewhere around 35,000 crores?
You can say ballpark 4 into 9,000, around 36,000 crores.
Okay, and sir, we will be spending over 3 years, right? FY27, 28 and 29. That's
probably 3 to 4 years. Actually, after order placement, it is around 36 months. That's the guidance.
Got it. So my second question is with respect to this NMDC contribution. Can you explain how is it getting accounted? Is the volume boosted because of that, or is it just some line item in revenue and some cost associated with it?
It's basically it's appearing as a line item as well as a part of the stock as well. So that is how it is appearing right now in the books of accounts, and in the books it is very clear. Once we see it, we can understand.
Okay, so can you explain what is the line, revenue and cost contribution in 1Q for this?
It's kind of a purchase actually from their side. Purchase of stock. So purchase in the stock you can see in the purchase in the expenditure you can see it is the purchase of stock in trade. It is appearing as purchase of stock in trade, and it is also there on the revenue side.
Okay, and the volume of 4.55 million ton, does it include anything from NMDC's volumes also?
In quarter one?
Yeah.
Yeah, it includes around 0.37 million tons from there.
Okay. All right. And sir, what would be the margin contribution or difference between revenue and cost for this?
What? Of NSL? You're talking about
margin? Yeah, margin contribution of this NMDC marketing, what we are doing.
No, it is done based on an agreement between them and us, and on that basis we do it.
So at EBITDA level, it is neutral, or is it positive? Is it negative?
It could be, and details. It could be a little bit positive, because which will be compensating the efforts being made by marketing team.
Okay. And then, sir, for a full year volume guidance...
Sir, but I may request you to rejoin the question queue for follow-up questions.
No, just a clarification. Just one last one. For this volume guidance of 17.5, are we including NMDC's volume in this or not including?
18.5.
Sorry, 18.5.
Yeah, that is with respect to sale products. Our products.
Okay. Understood. I'll join the queue back. Thanks.
Thank you.
Thank you. The next question is from the line of Vikas Singh from ICICI Securities. Please go ahead.
Good afternoon, sir, and thank you for the opportunity. So my first question is towards this railway pricing, this 74,000 which you said that this is finalized right now. What is the cost of basically production cost you are factoring, especially the coking coal? Since coking coal has been declining, is there a risk of this pricing coming down?
See, let me try to clarify this point. Actually, this cost is prepared after completion of the quarter and year, and then it is also examined by different levels, and then it will be done. So the point of 74,000, what you said, is basically provisional guidance. It has nothing to do with the actual prices.
Noted, sir. But then because coking coal prices have been come down significantly, is there any cost advantage which we need to pass on to the railway in the subsequent quarters?
Yeah, because if you remember, if you go back to 1 or 2 years back, the price of rail was pretty high as compared to what we are looking at right now. So this cost is examined by a competent authority at the government level, and after thorough investigation, examination, records, cost records, and everything, and accounts, everything, this is finalized. So the reflection of imported coal price is coming into the rail price itself after examination by the competent authorities. That is how it is coming, and as coal prices soften, so the rail prices also soften. That you must have already seen.
Noted, sir.
Because the coal prices are at this level, so things will also be at this level.
Noted, sir. Sir, in terms of our finished goods inventory, how much of inventory we are carrying, and is that inventory at the closing price of 1Q level? So there is a risk of markdown of these inventories as well going forward?
Yeah, let me answer this question actually. We are holding around 1.7 million tons of saleable steel and 1.3 million tons of in-process stock. So these two put together steel stock. It is steel stock. And it is proved up to Q1 cost right now, which are almost at a very lower level. That's the reason why the stock valuation impact has come, as we already explained. So going forward, we do not see any further reduction in this. There could be improvement, but no reduction.
Sorry to interrupt, sir, but I may request you to rejoin the question queue for follow-up questions. The next question is from the line of Rahul Gupta from Morgan Stanley. Please go ahead.
Hi, thank you for taking my question. So just to understand, you have some inventory of in-purchase stock, and you are marketing NMDC steel products. So can you please help us understand how should we look at sales of NMDC steel from your end for rest of the year?
Yeah, that is based on the contract and then their requirement. It is being done. So exact numbers, it will be very difficult to tell right now. Because the plant is also sort of ramping up, and they have their own ways of doing it. So as per the requirement, and the quantity cannot be frozen at this point of time regarding NSL numbers.
Okay, got it. And just to reconfirm, 18.5 million ton volumes for fiscal 26 is excluding NMDC, right?
That is our target for steel authority.
Got it. Just one more question. Where are we in terms of coking coal inventory right now, and where is it compared to normal inventory days?
Yeah, let me tell you actually, coking coal inventory right now is hovering around anything between 25 to 30 days in the ports, and could be around 5 days in the plants. So those are at the normal levels that we generally expect. We try to maintain those levels of 25 days, something like that, hovering around that. So right now the stocks are also at those levels.
Okay, got it. Thank you so much.
Thank you.
Thank you. The next question is from the line of Rashi Chopra from Citigroup. Please go ahead.
Thank you. Just wanted to clarify the NSR. What is the blended NSR for this quarter?
For this quarter, the average NSR is 51,700 rupees per ton.
And what was that in the fourth quarter?
50,100.
And for July?
And for July, this figure is expected around 50,000 rupees.
Okay. Thank you. Then on the coking coal side, you mentioned the blended coking cost was 16,900. What was the imported coking coal?
This is the imported coking coal is 17,600, and average was 16,900.
And the imported coking coal was 18,500 in the fourth quarter. Is that correct?
In fourth quarter was 18,500. You're right.
All right. And just last question on the inventory, that number 1.7 million finished and 3 million total, what was it in the March quarter?
In the March quarter, it was 1.7 against my 1.4 and 1.3 was 1.3. So basically, March quarter was 1.4 plus 1.3 and 30th June is 1.7 plus 1.3.
Got it. And sorry, just one more question. NMDC Steel, you indicated that the revenues were about 1,800 crores in this quarter.
Yes.
And the purchase on stock in trade that you mentioned is about 2,000 crores in the P&L. But
something will be in stock also. After purchase, something will be lying in the stock.
So is it fair to assume that you're pretty much breaking even at NMDC, or there is something positive?
In our case, actually, we do not have a negative. We have positive only in that.
Oh, can you quantify that?
It's break-even plus positive, actually.
Okay. Okay, thank you.
Thank you.
Thank you. The next question is from the line of Tushar Chaudhary from Prabhudas Lilladher Private Limited. Please go ahead.
Good afternoon, sir. Thanks for the opportunity. Sir, this NMDC Steel, you said only revenue and this raw material line gets affected in P&L. There is nothing in other expenses, right? Or is there anything in other expenditure also? Because this quarter's other expenditure seems to be on a little bit on a higher side, even if I look at on a per ton basis.
Yeah, there is nothing of NSL in the other expenses. The other expenses are higher compared to last year quarter one, primarily because of the royalty.
Because of the iron ore royalty.
Iron ore royalty, yes.
Okay, and the tendering process at ISCO had started last quarter. So how long do you think this will take?
As per the scheduled dates given by them, actually, order placements will take place in 25-26.
So order placement, do we expect by third quarter or fourth quarter?
Yeah, end of third quarter and fourth quarter, all of fourth quarter. I mean, the schedule is December, January, like that.
Okay. Thanks a lot, sir.
Thank you. The next question is from the line of Ashish from MLP. Please go ahead.
Let that be the last question, please.
Okay, sir.
Thank you, sir. Thank you, sir, for the opportunity. So one quick clarification. On the stock revaluation of 950 crore, how much of it would be because of coking coal and how much of it would be because of finished steel?
I mean, it is on finished steel. It is on steel only, finished as well as in process put together. And the reduction in the cost, which is given 950 crores of adverse impact with respect to quarter four, is primarily because of the imported coal price.
Okay, I'm not able to understand.
Because the imported coal price has come down by around 5,000 to 6,000 rupees per ton. That is why the cost of production is also down in quarter one as compared to quarter four, as well as previous year quarter one. That is why the stock valuation rate, which is equal to the stock valuation cost, so it has come down. And it has got an impact of around 950 crores with respect to quarter four. So the reduction of cost is primarily on account of the imported coal rate.
Understood. So then is it fair to say that as the imported coal rates increases, then the impact to us would be much lower because then we will get a revaluation benefit on the upside?
Yeah, of course. Going forward, suppose the stock is lying over here, or similar quantity or less quantity or more quantity, and if coal prices go up, then the stock valuation rate will also increase, and that will also increase the positive impact on this.
And if I look at the next quarter versus this quarter, so we will not have this 950 crores of impact, then 250 crores of additional royalty or excess royalty because of the iron ore price, IBM price are now more or less flat, so that should not be there, and then there will be a negative impact because of realization. Is that the three variables that we should look at for the next quarter?
These are the three basic reasons, actually, basic variables.
Okay, fair enough. Thank you.
Thank you. Ladies and gentlemen, we will take that as our last question. I would now like to hand the conference over to Mr. Ashish Kejriwal from Nuvama Wealth for closing comments.
Yeah, thank you, Amshad. Sir, before we ask for the final call from you, just last question from my side. When we are talking about stock valuation impact, definitely that's there. But In other expenditure also, we are seeing it's on a much higher side because more or less fourth quarter versus first quarter, it was flat despite the fact that volume was lower. So we are more concerned about the higher other expenditure as compared to what it was in the fourth quarter. And secondly, in terms of valuation, when we are talking about it's 950 crore, assuming that nothing changes in second quarter, only price variation is there and cost is not going to change, then definitely second quarter versus first quarter, do you think that our earnings will be deviated only because of the price change, steel price change?
Yeah, let me answer one by one actually. So far as other expenses concerned, other expense within other expense, one of the major components is royalty. Apart from that, handling and other expenditures are also there. So in the royalty front, because of the IBM price movement, so these figures also change. In quarter one, the figures are higher. That is why other expense figure is higher. But this may vary from quarter to quarter depending on the IBM prices. Now coming to the stock valuation rates, because that was a one-time kind of a hit in quarter one, so that it will not be there in quarter two, so it will give us a relief in quarter two and going forward. So the variability will be again be primarily driven by the NSR front. In the NSR front, and we are hopeful that we'll be doing our production and technological parameters as per our own guidance. So primarily the NSR will be driving the fluctuations.
Understood. So rightly you have pointed that base, whatever we have given in first quarter, from there to second quarter, main variation is because of the steel price.
Yes.
Okay, that's great, sir. So if you can give the final remark, then we can close the call.
Yeah, thank you very much. So while we are quite concerned about the global economic scenario and focus, the Indian economy has stood out as stronger with strong demand and consumption patterns. The forecast for Indian economy by various agencies have been quite encouraging, and the economy is expected to grow in the range of 6.3 to 6.7% over next 2 years, which is enough to categorize it as the fastest growing amongst the major economies. The steel demand forecast by WSF for India are also quite promising in excess of 8%. The government focus on infrastructure spending is a big boost to the economy in general and steel industry in particular. The residential sector is also expected to grow, backed by affordable housing projects and urban demand. India's capital goods sector is also expected to benefit from the momentum in the infrastructure and investment in renewable energy. Automotive and consumer durables are expected to maintain healthy growth driven by sustained growth in private consumption. The company remains committed towards improving operational efficiencies, and with the market expected to be more good in supportive in coming quarters, I am hopeful that the good times await us and our investors going forward. Thank you very much for this interaction.
Thank you. On behalf of Nuvama Wealth Management, that concludes this conference. Thank you for joining us, and you may now disconnect your line.